Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The first name on the list was Edward Morse, absolutely definitive within the global zeitgeist, if you will, the Washington Consensus on Petroleum, all sorts of efforts here, including his work with the Council on Foreign Relations. And we're honored that Dr. Morse would join us in our studio today. Welcome to Bloomberg, Dr. Morse. When I look at this, I think the arch question is a cup of coffee this morning with the President of the United States. How would you brief him on the timeline to get Venezuela to a new Caracas, a new Venezuela?
The timeline is very, very long. The timeline includes not just what must be done on the oil patch, but also includes how do you get this government to cooperate with the United States. And yes, they're starting out on a good foot, but this can't be done without a change in the entire view of the government of how they do what they do. They're there to make money. They're there to control things. And they can't do that and have the oil patch resume what it was like 25 years ago. This
is a transactional president. You have lived with your iconic work at Citigroup, a transactional big American banks enjoying losing big money in Latin America and other places. What do you perceive as a relationship of President Trump with Mr. Diamond, with Mr. Moynihan, and with other financiers of America?
Well, he's got a good relationship with the financial sector for all kinds of good reasons that we could get into. That's a separate subject. But here, the capital has to come from oil companies. And oil companies look at risk. They look at the risk in the marketplace. What is the supply-demand balance? They look at the risks of an investment. And in the case of Venezuela, they need a lot of capital going into infrastructure, and that infrastructure has to be in place before the oil comes out of the ground. So we're talking here about billions of dollars to restore the infrastructure that will get things going to allow oil on a sustainable basis to rise by a mere 400,000 or 500,000 barrels a day. That's $20 billion. $20 billion is not nothing when oil companies have opportunities in Guyana, opportunities in Argentina, opportunities in Brazil, and opportunities in Africa. So the question is, what will attract companies to spend the capital that Trump needs for the transaction to work?
Paul, Chevron debt 11.7% is where they are right now, just as an example.
What do you think the U.S. government, or what do you think those energy companies would need from the U.S. government in terms of assurances or whatever to commit that capital, do you think?
Well, they need the reassurance from the Venezuelan side as well as from the U.S. government, because the U.S. government said it is not taking over Venezuela.
Yep, good point.
So it needs to have the confidence, which will be step by step, and I suspect that the first step will be with Chevron, to see whether they can make good in short-term input of capital with short-term return. So I think it's going to be a slow process, but it will be trust building on trust, and we'll see how smooth that transition goes.
Talk to us to just describe the energy. When we talk about Venezuela, what do they have? What do they need? How big are they? How important is this? Because I understand there's a lot underground.
It's quite important. So the world has known for a long time that Venezuela has the largest known oil reserves in the world. The problem is it's not the kind of oil that the rest of the world needs or wants. And the problem is it's in Venezuela. And it's complicated oil to get out of the ground. But they've done it before, and they've managed to go from under 2 million barrels a day to 3.5 million barrels a day in a relatively short period of time, a couple of decades ago. So if the will is there and the government is there to provide the guarantees, but to do that, you need the government institutions to be reborn. Those government institutions have themselves deteriorated dramatically. They don't have the human resources. They don't have the personnel to be able to guide it. So part of the process will be a return of that human resource base.
Edward Morse with us for a lengthy conversation this morning with Hartree and, of course, Definitive at Citigroup, among other services to the United States over his long decades on petroleum. on hydrocarbons. I believe I've shared the stage with you and Shannon O'Neill at the Council on Foreign Relations. Dr. O'Neill was on with us recently, exceptionally gloomy about Venezuela's ability to reorganize given an event like what we've seen. I assume you've been to Caracas more than 40 times. You remember Caracas from another time and place. Do you have any optimism that they can move from a Cuba-like society to something that can get capitalism done?
Well, you have to be a little bit optimistic given the change that has already taken place. So getting Maduro out of that position is a major step. And now the government is in a crisis of survival. That survival will require them to cooperate with the U.S. So the options that they have are quite limited. Who is going to replace the U.S. At this moment in time, given the U.S. military position, the naval position surrounding Venezuela, the control that the U.S. has over Venezuelan exports? It's not easy to imagine a replacement for that. So the good news really is that they are cooperating to start, and we'll see how that goes. But it will be a long road with difficulty.
Is it your understanding, just based upon the limited reporting that we have in the last 48 hours, that the government of Venezuela was in contact with the Trump administration to facilitate Mr. Maduro being taken?
Look, it could not have been done without there being some contact within the government.
Okay.
We know from reporting that that the intelligence operations preceded this. They were on the ground. They had to have help to be on the ground. And undoubtedly, they were not taken by surprise because of the smooth way events went on over the weekend.
How do you think China is viewing what's going on these days?
China's in a difficult position. They are a massive creditor to Venezuela. Venezuela has been central to the Belt and Road Initiative in enlarging China's influence in Latin America. Excuse me, and it's been frankly a failure. They have between 50 and 100 billion of debt. Their operations right now are to export oil to pay for that debt. The U.S. controls their exports out of Venezuela. So they came down and condemned the U.S. government. They had to do that. But they have to take a quiet approach because there's so much at stake between them and the U.S. on a global basis, so much at stake on a bilateral basis, right, including their tariffs that they want to see some resolution on. I think we'll see quiet diplomacy with China and the U.S. rather than stamping on the foot or saying anything about military force.
In my reading, I've heard that. But what does Edward Morse, I'm going to butcher the pronunciation, Dr. Morse, do we need to show the flag this morning in Kaohsiung Port in Taiwan? Does the U.S. Navy need to get over there and, like Perry centuries ago, show the flag?
Tom, I think the U.S. showed the flag before Maduro was taken out. They showed the flag with a massive military sail to Taiwan.
Right.
And the military has been there. The Navy has been there. China is not in a position to fool around with the U.S., even with much of the U.S. naval fleet now around Venezuela. So I think it's going to be stepping, very lightly on what could happen.
Edward Morse with his folks, a special edition of Bloomberg Surveillance. We've really held back the commercial interruptions to give you this conversation for America around the world. You have such a relationship with Faisal and On in Saudi Arabia. How does the Middle East in general, and particularly Riyadh and Jeddah, how do they respond to these actions?
They're responding quite quietly. Riyadh is looking at the global setting. They know that Venezuela could be a threat to the production agreement within OPEC Plus, but not in the short run. In the short run, they're looking at the year ahead. The year ahead is quite uncertain and quite messy, and it was that way before the taking of Maduro. So we have Russia-Ukraine. We have uncertainty on the distortion and disruption side around the world, and the Saudis have also a military tie to the U.S. that they don't want to lose.
Right.
So they have to, and they looked at their budget. The budget requires a lot of borrowing. That borrowing may include in their own minds how low can prices go for us to continue.
Folks, I failed, Paul. I failed. Ed Morse nailed the decline in oil. Do you have a lower oil target from here for Hartree?
So we don't know how low the price will go. It's lifted a little bit by the geopolitical risk. I'd say the supply-demand balance, which is higher supply than there is demand now and going forward, is for oil testing Brent at 40.
Okay.
And I think testing Brent at 40 is something the Saudis can swallow. How much lower than that they can swallow it is not known.
I want to get this in because Paul's got 8 questions. So you're going to go visit Trump. President Trump is going to be an Edward Morse coffee with the president. You're going to talk about a transactional American president. And I know you're going to get a phone call from Ottawa where Mark Carney is going to go, Edmonton's playing Ottawa. Ed Morse, come join me at an Ottawa Senators hockey game. I mean, this is the way it's going to work. What do you say to Mark Carney of Canada?
Well, I'll start with Trump because I haven't answered your question on what I say to Trump. And what I say to Trump is your policy on energy dominance is a wonderful strategy. But, Mr. President, I think you're ignoring some things about energy dominance. And there are 2 things about it. One is that you can't get to where you want without having a significant growth, because this is a world transitioning to electricity intensity. And you can't do the electricity intensity you need for AI and cloud computing and energy dominance without renewables. You can't do it even without hydrogen. So you've got to enlarge what you think about energy dominance. And then, Mr. President, you've got to think about the U.S. The U.S. is not one country when it comes to energy. It's 6. We have 2 exporting segments in the U.S. They are the Gulf Coast of the U.S., and I'm not talking about the Gulf of America or the Gulf of Mexico, but the Gulf Coast. And we have Alaska, both exporters of fossil fuels. And then we have 2 massive importers of fossil fuel with no tie. And, Mr. President, here is the lesson. The reason that we have 2 importers on the West Coast and the East Coast that are massive in scale, global in scale, is because another period of dominance around World War I, we thought we were the best shipbuilding country in the world, and we wanted to retain that dominance. So the Jones Act was enacted. And the Jones Act has meant that when it comes to energy, we are importers because we can't afford American ships to take oil from the Gulf Coast to the West Coast or the East Coast. We need foreign vessels, and they carry foreign ships.
So this is the moment to do away with the Jones Act.
This is the moment to do away with the Jones Act. And also to tell the president energy dominance, a good idea, needs a little bit of massaging at the edges.
I mean, the photograph of Theodore Roosevelt with a map of Venezuela behind him from, I believe, Paul, 1909, was just stunning. I mean, this history going back here. Paul Sweeney with Edward Morse.
So when you go down to Houston, you talk to these big energy companies today, are they happy with what's going on in the last 24, 48 hours? Or are they apprehensive? Do they see a big opportunity here?
They see a better opportunity than they've seen in years, but they are apprehensive. The risk of putting capital, their shareholders' capital at risk looms extremely large in their minds. So there's not going to be a rush to put money into Venezuela until we see what the structure of the investment might look like.
I'm surprised I don't see a move in WTI and Brent crude today. Now, I couldn't have told you, is it going to be up 5% or down 5%? But we kind of got nothing going on here today.
Well, in my prepared remarks, I thought that was the first question. I didn't know, that we were going to have prices go down a little bit.
It's Bloomberg surveillance. We make it up as we go.
We're winging it.
No, I'm not surprised.
Okay.
There is no change in the energy market, period.
There you go. All right. So, but I think at some point, it just feels like almost OPEC and OPEC Plus become less and less relevant every day.
OPEC and OPEC Plus have become less relevant every day since the beginning of this decade. And when we look at the positions that have put this in place, it's not just the rise of Guyana and Brazil and Argentina again, but it really is the U.S. The U.S., I have this battle with my colleagues at work almost every day. The U.S. is not just a crude oil producer. It is a massive liquids producer. We are a producer of 24 million barrels a day. And our growth has been in natural gas liquids. Natural gas liquids compete with oil out of a refinery. They compete with gasoline. They compete with distillate. They compete with fuel oil. They're there for transportation. They're there for home heating and power generation and industrial use. So we are the disruptor of the global market, and we're the ones who put OPEC Plus in a position of defense.
We're going to have to wrap it up here. We've Mark Champion coming up, folks, from Europe with all of his decades of experience. Dr. Morse, some of the highlights of my career here have been with you and with Daniel Yergin. If I was to get Yergin and Morse together and look at the prize, just the romance that I, as a kid in college, read cover to cover, we got to find the romance for Venezuela to save a society, to save a region, maybe to support the Donroe Doctrine. I don't know. How do we get the romance back that you knew working there, that I knew as a student?
I don't know how we do that. I know that I'm not going to bring the romance back, and Dan Yergin certainly has the ability to do it. By the way, I was an early reader of the prize. He and I knew each other in graduate school. We were in different graduate schools. And when he wrote the prize, the original version that I read was actually twice as long as the version in print. So he had to cut out a lot of wonderful text in order to put out that brilliant book.
The book was, Paul, you had to walk around, even if you didn't read it, you walked around with it,
yeah,
to be cool. Yergin talked about this unique American relationship with various and sundry banana republics, Reagan and Grenada, and the rest. Can we develop a new process with Central and Latin America, or will this be the same old through the rest of the Trump term?
No, I think there is a process going on. If we look at elections that have taken place in Latin America, there's a rebellion in those countries against corruption. There's a move from the corrupt left to the right. We've had a corrupt right in the past. But it's been a very constructive set of moves from free elections. So I think Latin America is in a very good position now, better position than it's been in a long time. And part of it is the lessons learned from China overspending and having a view that all credit has to be repaid.
Wow.
Paul, we got to get to Mark Champion, but Dr. Morse, I got to bring this up. Paul said you got to ask the question, Tom. What's it mean for landman?
Thank you very much for inviting me. It's been a pleasure to be with you.
Ed Morse, thank you so much. With Hartree, and of course, Dr. Morse with Citigroup for many years. Edward Morse there. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Keith Lerner, he's the CIO and Chief Market Strategist at Truist. Keith, as we think about 2026 here, we got geopolitics front and center here today to start kind of the year off right. Let's step back just a little bit there. What is your outlook for markets in 2026 after just outstanding results in equities and bonds and commodities in 2025?
Yeah, well, first, great to kind of bring in the new year with you guys. Great to be on. So our outlook that we published in December was called the seventh inning stretch. And the way we thought about it is, we've come a long way in the economic cycle and the markets. It was a good time to kind of assess where we are. And our bottom line is, our weight of the evidence approach suggests there's still upside in both the economy and the stock market. So let me just share a couple of stats with you. The first one is, we just had our third year anniversary of the bull market late last year. When we look historically, there's been 7 bull markets that has had a third year anniversary. All of them saw gains over the next year. It's only a sample size of 7, but as a starting point, that's a positive. If I lay on top of that the Fed once again in December cut rates when the S&P was close to all-time highs. When you test that out, about a year later, the market has been up more than 90% of the time. So that's also a positive. And then you mentioned the earnings side. The PE for the overall market last year was flat. For the technology sector, it was actually down. And all the gains really last year were earnings. As we move forward, we expect low double-digit earnings again. That should support the overall market. I will say it is a midterm election year. Those tend to be somewhat more volatile. We have our first curveball that we saw here with Venezuela over yesterday.
What I got most wrong last year was I was in the triple leveraged all cash fund for the entire year. Paul, cratered. I mean, I cratered. Keith Lerner, what'd you get most wrong last year?
What did I get most wrong? I would say I thought, when you think about the April trade side, we downgraded equities in February. We told our investors do not sell at the lows. But then after we had the initial pop, we took a little bit off the table. So I think that's probably, if you say what you got most wrong, what I'm proud of is that we didn't stay there too long. We then upgraded stocks shortly thereafter. But it was, we followed this way of the evidence approach, and, it overall led us directionally in the right way.
So fixed income here, high single-digit returns in 2025. In 26, is it just a function of clipping the coupon, do you think?
Yeah, I think so for the most part. I mean, our house views is the 10-year drifts towards 375. So maybe you get a little bit of price appreciation. And relative to the last 10, 15 years, yields are still somewhat attractive. So, yeah, we think, we basically clipped the coupon. That's why with an overall asset allocation, we still have a modest equity tilt. And we still, all year long last year, we had a position in gold, which we called the MVP. And we still like gold as we move into this year, at least from a portfolio diversification standpoint.
What do you say to people, Keith, like they participated, but maybe they were, 60-40, they were more fixed income? Or Paul, how many people are in cash? The money market fund's 3.x%.
Yeah.
Kathy Jones is not aged. She's the only one that hasn't. Hey, Keith Lerner, you're talking to Kathy Jones at Charles Schwab or anybody else. When do you make the shift to equities?
Well, I don't think it's like a on-off switch. In our view, we actually have, just kind of target levels of cash. We've been telling folks if you have excess cash to work that in the market. It could be in equities. It could be in fixed income. And, you just mentioned, bonds underperform stocks. But, you really what you're paying for or what you're looking for from fixed income is to clip that coupon for income and some stability. So I would still be working that money in. We still think there's upside in the equity market. In the fixed income market. And we do think that we'll likely see 1 to 2 rate cuts this year, which means those short-term money market rates are likely to come down. Or as our fixed income head says, the era of buying the T-bills and just chilling is likely over. So I think there's still opportunity.
See how Keith did that? Kathy Jones is at peace sitting in our studio. Because Keith's saying, take the coupon and see if they go, give one more for Keith Lerner.
Hey, Keith, as good as the equity returns in the U.S., in 2025, they were better outside of the U.S. How do you think about U.S. versus rest of the world in terms of the equity markets in 26?
Yeah, big picture, we have a modest overweight to the U.S. We have, over the last 15 months, increased our international. We have a global bull market underway. I would just say, though, a lot of focus on how much the U.S. underperformed last year. Zoom out. The year before, the U.S. had outperformed international developed by the most since the 90s. And it's still more than about double the outperformance of international over the last 5 years. So listen, I think there's opportunities globally. I want to have more allocation there, but we still have a bias for the U.S. because the earning trends still remain strongest domestically.
Keith, thank you so much. Keith Lerner with us with Truist to get us started in the equity markets. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now for too short a visit, Henrietta Treyz joins us from Veda Partners. Henrietta, an open question. What will you study and listen for on Capitol Hill this morning?
Yeah, that's the question of the hour. I would say that the White House likes to tell Capitol Hill that they are incredibly transparent. And I think what they mean by that is that they talk a lot and they tell voters, they tell lawmakers what they're thinking in real time. So one of the things that's most important to me is what comes after Venezuela. Obviously, we're hearing about Cuba, Colombia, and Mexico. And I point out one thing that I think is really important for investors right now, which is that Ambassador Greer, the USTR, has stopped putting into writing the way that the United States is planning to treat the USMCA, the U.S., Mexico, Canada trade agreement. They're saying we're going to basically adapt to this on the fly. We are going to be updating things as Mexico responds to our incursions in Venezuela, what might be coming in Cuba or Colombia. They're telegraphing that there's more to come. So I think when members on Capitol Hill get their briefings, they're not going to be concerned about the who, what, where, when, why of what happened over the weekend. They're looking to what comes next and getting out in front of it. And I think the White House is telegraphing that there is much more to come.
Henrietta, what do you with 24 hours of hindsight here, what do you think the political calculus was for President Trump and his advisors as it relates to going into another perhaps open-ended commitment to another country versus kind of what he said on the campaign trail about, like, that's not what we're going to do here. We're going to get ourselves away from that type of foreign policy. How do you think that worked out?
Yeah, I think so far what's happened is that no one can say anything negative about what actually went down. There's no military deaths on the United States side. It was fast. Maduro and his wife are in the United States already, awaiting trial right now. So it's going to be the fallout and sort of wrangling members going forward that they're going to need to do with every single piece in their arsenal. So the briefings on the Senate side today between the House Republicans and the president tomorrow, it's going to be imperative that they keep dissent to a bare minimum. So I think that's going to be successful. I imagine they lose 2 votes on the Senate side and maybe 2 votes on the House side, but they can keep dissent at bay, keep the war powers resolutions at bay, and that's got to be their number one priority, keep the Republican rank and file in line.
Do you think President Trump or in the midterm elections, the Republican Party will pay any price here for this type of foreign policy?
That's the question. I would say no, mostly because American voters do not care about foreign policy. So unless there are military deaths, this can go downward, but there's not an upside for the president here. Gas prices are already low. It's going to take years to bring Venezuelan oil onto the market. You all pointed out previously that maybe Europe benefits here, but this is not going to bring gas prices down in the United States is the expectation of all the investors I spoke with and energy sector experts I spoke with this weekend. So I think we're really still on affordability, inflation, jobs, prices, and it is by far and away the number one issue of voters. And they don't like the president's handling of it. And that's the reality that the White House and the Republican conference have to face.
Henrietta Treyz with us, Veda Partners. We continue where they're into this closing hour of Bloomberg surveillance, a 7 o'clock hour here in New York. In our next hour, Michael McGlone, Damian Sassauer, Edward Morse, Mark Champion, I think from London, as well as Lisa Mateo. Henrietta, unspoken in the X number of briefings I've read in the last 40 hours, 50 hours, is the United States military, and particularly our Navy. Is the feeling in your contacts that our military is stretched?
I don't get that impression, mostly because, as you've seen, federal spending on the Navy, on the Coast Guard, on the Marines, everything has gone up this year. Federal spending is up 6%, and that's going to continue. So one of the things that we don't have is a defense appropriations bill beyond January 30th. And that's really important because the White House is now in a position to come and request more money for the Department of Defense, for the Pentagon, for any of the agencies associated with the military. And you can bet your bottom dollar that request is coming in. One of the things they might like to do is delay that request so it doesn't look like this incursion is costing money. They can push it out into February and March. I suspect there will be a short-term CR that punts on long-term solutions to the Department of Defense and spending there, but there's going to be more money flowing to defense.
Is Washington fighting the last war where what we need is another aircraft carrier, or is the answer 6 million drones?
Oh, man, are you bringing in shipbuilding? I will talk about that all day. I mean, I
know.
Very much
Your
shipbuilding.
Your agent called me at 3 a.m. and said, Tom, shipbuilding, Henrietta.
Yeah, I mean, if you're going to bring up trade and, what we're doing on tariffs and all that, it's very much associated with shipbuilding. You can see it in the president's, not finished, but endeavored trade deals with Japan, with South Korea, with China, bringing shipbuilding back to the United States. So that is definitely a part of what President Trump wants, actual physical, almost like Battleship the game. Make sure you have those ships here in the United States. They're actively working to build that out.
Henrietta, we are obviously focusing today and probably for the days to come on geopolitics, but don't we have to keep this government open? What's the status there?
Yeah, we sure do.
To you, domestic.
the government is prepared to shut down on February 1st if they don't reach a deal. The reality on that is that, as I mentioned, defense is not even funded. The Labor Department is not funded. So we're at the same sort of negative for the markets situation going into February as we were back in October, where we lapse labor data and BLS data, et cetera. So there's a lot of work to be done. The House and the Senate are on two totally different pages, which is why I suggest that maybe we'll get 1, 2, even 3 long-term bills funding various sectors of the federal government. But for the most part, we're going to be operating on a short-term basis, probably into March. I could see another CR. My odds of a shutdown are low, 25% or lower. But it's going to be a major topic of discussion into the end of this month.
What else is on the agenda for Congress here going forward here? Because, again, I'm assuming geopolitics is going to supersede a lot of this, at least in the coming days.
Yeah, for sure. And so anything that you thought was going to happen is not going to happen. So a second reconciliation bill is highly unlikely. The one caveat I'd put on that is to say that there is an effort from Lindsey Graham, the chairman of the Senate Budget Committee, to put military spending into a second reconciliation bill, which would be pretty novel in terms of what you can do under that authority. But that's something to be mindful of if the president really does come in with a massive request for the Pentagon in the wake of the Venezuela incursion and what's to come in Cuba and Colombia and elsewhere. Right. So that's worth being mindful of. But I'm low odds, 20% or below. We're not going to get that tariff rebate dividend check. The biggest thing that's actually going to happen is the Supreme Court ruling on tariffs. Everything else that Congress wants to do, whether it's on crypto or permitting or housing or whatever, none of that's going to happen.
Very quickly here, a nerd question in honor of Greg Giroux, our great polling axe. Has Mr. Trump lost the Latino vote, and did he get back the Latino vote this weekend?
That is definitely a great demographic question. The Venezuela vote is heavily concentrated in Florida. I would suggest it's maybe worth 2 or 3 percentage points from the Latino vote in the state of Florida, but it's not widespread throughout the nation. And the Latino voter from Jersey, Virginia, Tennessee, even across the country, certainly California, you've seen absolutely hemorrhage support for President Trump in the wake of his immigration and basically his economic handling. When you see Democrats outperforming Republicans on their handling of the economy, that goes to every voter, Latino or no. So I don't think that the Venezuela piece is big enough to move the entire Latino vote. And that's going to be a misnomer heading into the midterms.
Henrietta, thank you so much. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Right now, as you mentioned, Kathy Jones joins us. She's Fixed Income Strategist at Charles Schwab. I got 8 ways to go here. Let me pick up on what Mr. Lerner said, is that even if you own NVIDIA, there's a place for bonds, notes, and bills. Explain to the tech bro why they should be looking at your world.
Yeah, I mean, one of the basics of asset allocation is to have some risk assets and some less risky assets. So you get diversification and they're not correlated with each other. So that gives you that efficient, want to be on that efficient frontier, right? Where your return is high, but your risk is mitigated. And that's the combination, the magic combination when you do asset allocation that you're aiming for.
We've got, it feels like a steepening yield curve here. How do you think about that? What does it mean for the marketplace?
Yeah, we've been riding this steepening yield curve trade for about a year now. And I think one of the questions I have is whether that continues in light of the expectations of lower inflation due to lower oil prices. I think it's premature to make that decision right now. But as things are playing out, perhaps there will be the expectation of more supply, lower oil prices in the future, therefore less inflation. But for now, we still have the Fed easing, so that means short end probably still come down a bit. When you get to intermediate to long term, you still have problems that could keep yields sort of where they are, and that would be sticky inflation so far, and the deficit and the need to deal with supply.
I was channeling Paul this morning. First chart I looked at on the Bloomberg terminal was the difference in yield between the 5-year and the 30-year. Paul, the only reason I did that was Steve Major.
Yep.
It wasn't, it wasn't an original thought from Tom Keene. Explain to our audience, they know that vanilla is the 2s10 spread. You can go 3 months to 30-year like the whole curve. Explain the efficacy of pistachio, the 5-year to 30-year spread.
Yeah, I think when you're looking at 5-year to 30-year, what you're really trying to do is scope out, the really long term, what really long duration can do for you. When you go into the 30-year, it's going to be more volatile, and it's going to really reflect the long duration view, right? You take a fair amount of duration risk in that, or you take a lot of duration risk in that. So you have to be really convinced that the long-term trend is towards disinflation for that to really make sense, or to get so much yield that it compensates you for the risk of volatility along the way and surprises along the way. And if you're a trader, you may look at that. Most everyday investors don't go out to 30 years.
Mm-hmm. So in 2025, you got paid for taking some credit risk. How about in 26? Are you going to get paid for credit risk, or do I just stay a little bit closer in on my credit?
Yeah, the credit spreads are still tight. We're seeing some deterioration in the underlying market. Again, we'd be cautious. It's not that you can't take some credit risk. It's that you don't want to take too much credit risk. And this is a highly unstable environment right now to try to predict, where corporate profits are going to go. They look good, but it's priced in. A lot's priced in. So we'd be kind of cautious.
Paul, I don't mean to interrupt, but that sounds exactly like 90 days ago, 180 days ago, 270 days ago. Remember before the earnings season?
Yeah.
OMG, we're not sure. And then what is it? January 14th, 15th? Whammo.
Some solid earnings across the board here. In 2026 here, are there sectors that screen well for you? How are you thinking about finding opportunity this year?
Yeah, we like tips.
Okay.
We think they're well priced for real return. So you get a positive real return. And I think the investors really haven't latched onto this because they've had some difficulty kind of reading the tips market. But we think tips look pretty good. We think munis are undervalued right now.
Right.
And that's because supply has been really large. But if you're in a higher tax bracket and a high tax, even if you're not in a high tax bracket, they can make sense for tax equivalent yields.
I wouldn't ask you this question in March or August, but it's January and my jargon police are out in force. What in God's name is a tip?
Oh, Treasury inflation protected securities.
So you're betting on inflation there.
Well, what you're doing is you're buying a Treasury that's indexed to the CPI, and it's the overall CPI, so not excluding food and energy. So right now, the way they're priced, you're going to get 1 or 2% above inflation, whatever that turns out to be. So that gives you a positive real return, kind of no matter what happens.
You and Lizanne look tanned and rested. Did Kevin Gordon get any time off? Did he work every day?
Kevin had a good vacation in there. He had some time off.
He had like 12 hours, like December 18th.
We give him a chance every once in a while.
Kathy, thank you so much again. Thank you for helping us with the Fed Decides as well. That will be January 29th. Ms. Jones is with Charles Schwab.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.